So again, in today's class, what we're going to focus on is completing the second part, what I'll call part 2 of the CAT valuation. And I want to talk about your next homework assignment as part of this. So if you go to the model data tab of the file that we've been working on, just structurally, what we're doing here is we're trying to build a reusable valuation model. So in the model data tab is the data from Bloomberg on these publicly traded companies. Now, a little history. What Bloomberg used to do until about a year ago is they had the standardized income statement, balance sheet, and cash flow statement. They were very convenient. So what Bloomberg will do is they'll take the GAAP statements and then they'll have somebody put, an analyst who would put the GAAP statements into a common format. So across all companies, you had common income statements, balance sheets, and cash flows. And that was great. But then a year ago, Bloomberg decided to be innovative and they changed it. So they got rid of the commonly formatted statements and instead they have these things called the adjusted statements, right, which are more geared towards what the analysts do. But unfortunately, those adjusted statements are not completely common across all of the companies yet. So we're in kind of this middle limbo zone where we don't have common statements. So here's what we do have. We have the common data, the database fields that build these statements. So that's what we now have on this model data tab. We have all of the core components that are usually reported off of the adjusted statements of the income statement, balance sheet, and cash flow. And that is what this list represents, which right now goes down about 79 items. And what I will tell you is that I believe that about 98% of the time that this will work for us. However, if a company reports something in their statements that is not covered by one of these database fields, we may have to add to this list. All right, it happened last semester. So a couple teams, it wasn't many, but they actually had fields that weren't previously on the list because when Bloomberg gutted their common statements, we had to figure out what's new. And I'm pretty sure that this won't affect you, but it may. And so I'll call it a 2% chance it could affect you. And then if it does and there's a missing field, we'd have to put it on this list and we'd have to sync it to our model. All right, but for CAT, that's already been done. All right, so basically this is the list. These are the database fields for the income statement, balance sheet. In column A are the friendly names, and column B are the actual database fields. Now here's the other thing. From time to time, to be helpful, Bloomberg will also change the labels or what it says in column A. All right, and that can also cause problems in our model. So what matters is column B, because column B is the actual database field name, and Bloomberg doesn't change those. All right, so it's very important that we have those in our model, and to make this a reusable model, we have to have it coming from Bloomberg in a format that is consistent, and therefore when we put it into Excel, for example, pension long-term liabilities always need to be on row 49. Because our model is always going to be looked to row 49 for that value. So if it's not on 49, it's going to cause problems. So you might say, well, how does this apply to me? So this is first half of homework 7. What all of you are going to individually need to do is you're going to need to go to Bloomberg. And I got logged out, so let me log back in. And once you're in Bloomberg, you're going to need to go to the FA section. I'll do in just a second as soon as I log in here. So go to CAT, and for that matter, you can go to any company, and then go to FA, which is the historical financial statements, and then go to Custom. And you'll see that I have a custom tab called Model. You can call it whatever you want. I'm calling mine Model. And this represents all of the data, row by row accurate, to what's in the Model data tab of our model. Right? So here's the thing. All of the CAT data came from this data export. If I wanted to do another company, Ford, then we go to Ford, we export it in that format, we overwrite this tab, and then our model then has Ford data in it. So it will take us 3 hours to create the first version of the model, It will take us 10 minutes to create a reusable version for another company. This is also what you're going to use for your group projects. So part of homework 7 for you is you have to recreate that model tab. You got to create row by row in the right order all 79 and growing list of fields into a Bloomberg template. So here's what you'll need to do. It'll take you probably 20 minutes. Just a tedious exercise you have to do once, but once you save it, it will then be there as a reusable tab. So you'll create a custom, right? So the first row in our model, you can see it here, is called revenue. Now, what I'd recommend is where it says sales underscore rev underscore turn. You can also copy and paste this. So if you don't like to type, Control or Command C, Control or Command V. What's more important is copy the database field into this field. So sales underscore rev underscore turn, and you'll see that it is called revenue as the Bloomberg field. You'll click on it, and then there it is. In fact, if you highlight it, you'll see where it says sales rev turn. Right? And then we'll do the same thing. Again, cost of revenue. So again, that's a long one. Copy, paste, paste, and that's cost of revenue. Boom, it's there as the second one. And again, you can verify you copied and pasted correctly because these need to match. Right? And so you'll just do that for those variables on the tab. Right? Now, when you're done, it's also important that in settings, for number of periods, 6. Make sure that you're exporting 6 years. We had previously done 6 years in a previous Bloomberg assignment, so it should already be there, but make sure it's 6 years because our model is expecting 6 historical years of data. Bloomberg can obviously give you more than 6 years, but our model is expecting 6 years, so that's the amount of data that you will export. All right? So once you're done with that, and you finish the assignment, so I go here to Model, and you have this. Then you'll go to Output, Excel, Current Template, and it will basically dump that into Excel. Yes, for security, and then Save As, and this is the first file that you'll have to upload for Homework 7. Okay. Now, by the way, you'll notice that when Bloomberg exports this, that there is a hidden column. Column B is hidden. It's there because it goes from A to C. And if you unhide, you'll see that the actual names are also in column B, right? Just like they are in our model. Okay, so they're actually being exported. You just don't see them by default. But when you copy and paste it into our model, they will be a column B there, right? So I'm saying that this has to match up exactly with the rows in this order. And that's very important to do it in this order. Because our model is always assuming that these fields are coming into these rows. If they're not in those rows, you'll break the model. Right? So that's the first half of Homework 7. Questions about any of that? Hopefully pretty straightforward. All right. So now let's talk about finishing up our valuation. And let's go back to the model and finish talking about how the model works. So back to the model. What I then did is I created a common income statement and a balance sheet in the tabs, which you did as part of your last homework assignment, so that we have the historical data and the forecasted income statements and balance sheets, right, in the common format, which then, and again I did this for you, I mapped to the economic statements. So we have the historical and forecast economic statements of TFI, TII, CFI, economic profit, and BOI and EOI. Okay? And if you remember from homework, last homework, basically what the forecast is driven on are by these ratios and these assumptions. Okay? And that got us a forecast of cash flows through 2021. Now, I just arbitrarily picked 6 years worth of forecast. And the reason I arbitrarily picked 6 years is the first 5 years are the defined period. Year 6 is the start of the continuing value period or the terminal value period for the company. So that's why we're forecasting N plus 1 years, in this case, 5 years of forecast, and then the first year of the continuing value period, which was 6 years. Now, just a little bit of background. I used to do 10 years in this class. right? And students would have to actually do 11 years worth of data and 10 years worth of forecast of the company. But what I found is that forecasting years 6 through 10 was really hard on the students and didn't really change much of the model. And so why make you forecast more data to do extra work that doesn't really have a lot of impact on these valuations to begin with? Because in the real world, forecasting out 6, 7, 8, 9, 10 years is actually hard, and most people don't do it. In fact, what you'll see in a lot of valuation models is people will do 5 years, right? But recognize that the 5-year models are just arbitrary. Yes?
I'm going to do it, but it's going to be hashtag name question mark so.
For what?
Try to export the Bloomberg itself.
It means that your Excel model is not hooked up to Bloomberg, so you got to reinstall the plugin. So there's an Office plugin that needs to be reinstalled on that terminal. And until you do it, it won't export it. It's going to be in the Start menu under Bloomberg, Office Tools, and you have to reload the Office tools. Unfortunately, these machines in this lab, sometimes when you reboot them, get wiped clean with a new model, and therefore it wipes out the link to the Office link for Bloomberg. That's probably what happened to your terminal. All right, so back to this. This was a final exam question a couple years ago. What's the right number of years to do a valuation forecast for? Like, how many years should you go before you do terminal value or continuing value? What do you think? What would be the right answer?
10.
Why 10?
We learned you like the 11th year.
Well, I know that's technically why, but I did say that that's arbitrary. Like, what's the actual real answer to make it less arbitrary? Yeah.
As far as you can.
And so that's until what? So that's the key. Until what? As far as you can until what? All right, so I'll give you 2 hints. All right, hint number 1. One of the challenges with continuing value is you have 3 or 4 values in the key value driver formula that represent 70% of the company's stock price. Think about that. Yeah.
Is it until your last year forecast equals the long-term growth rate?
Until you become very close to the long-term growth rate, so therefore when the company is stable and mature.
Right.
So that's the point. If I have 3 values or 4 values that drive most of the value of the company, I want those values to be reasonably certain and not change too much over a long period of time. So I want the company to be in almost a steady state. So the key is, how many years do I have to forecast until the company is in a steady state? All right. So if I'm doing a company like, and I was working this past week with Merck. If I'm doing Merck is basically a mature company. They're not growing at all. In fact, their next 5 years, they have 0 growth. So to be honest with you, if you really want to value Merck, you probably could go 3 years. You don't have to go 5 years, right? Because basically they're already a steady state. They're a mature company. But if I'm doing a biotech startup, I might have to do 20 years before that company actually becomes a steady state, kind of a mature company. So it really has to depend on enough years until the company becomes mature, right? And I'm not telling you that people don't do 5 years, because even when you do a startup, 20 years is really hard. But it just means that those slight changes in assumptions and continuing value have huge impacts on the value of the firm, right? And here's the other thing. It's got to cover a cycle, right? So think about Cat. Right now, if you remember, Caterpillar builds big Tonka toys, right? And the reason why people buy big Tonka toys is they want to do construction. Well, right now, construction's in a down cycle. So if I do 5 years, Cat may not emerge from the down cycle, and we know construction's a cyclical industry, so Cat's eventually going to have an up cycle. So if I just forecast their bust cycle and then go continuing value, I'm going to undervalue Cat because I only have half of their cycle. So what's also very important is that your model cover the complete cycle of a company. All right. So even when they're a mature company like Cat, if it has boom and bust, oil companies would be the same thing. If I'm doing ExxonMobil or Shell or somebody like that, I got to make sure I get the boom and bust cycle. Otherwise, I'll miss the valuation. So those are the 2 other key things. So I'm telling you, for purposes of this class, we're going to keep it arbitrary at 5 years. And some of you might even have cyclical businesses, and you'll just have to recognize that you're going to have to come up with a way to adjust for that, because you don't want to just look at a cyclical down, not an up, because then you'll misrepresent the real value of the company. But nonetheless, we're just going to arbitrarily do 6 years. Right? So back to our model. What are we going to do? Well, what's key about our model that you did in the first part of your homework is you created a forecast for cash flow, CFI. Now what we want to do, like the assignment you previously did, is we want to turn this into a valuation. So I'm going to add a new tab in Excel. So this is now the other half of homework 7, is to basically complete what I do on screen. If you complete it by the end of class today, then you finish the second part of homework 7. If not, you'll have until Monday at 10 a.m. Okay? So add a new tab, put it at the end, and we're going to rename this tab DCF, for discounted cash flow valuation. And I'll make it a little bit bigger so it's easier to see. All right. Now, when we first built the forecast model before the break, we had done it across the columns. But what I'm going to do is I'm going to actually put our forecast years down the rows so that if we ever print this out, it'll print out one-page portrait on a sheet of paper. Okay? So basically, what we're forecasting, we'll start out with the operating values of the DCF, is to calculate the operating values, we need the forecast free cash flows. And specifically, we need it for the forecast years. Well, our first forecast year of CFI was 2016. And as I said, we have 6 years, so the first 5 years of the defined period, so I'll just equals previous year plus 1, and I'll go through 2020. So these are the, assuming that the assumptions in our model came true, these would be the free cash flows for those 5 years. We will get those off the CFI tab. So in 2016, our forecast off the CFI free cash flow, 2016, 4135.4. Right? 2017 off the CFI is I-12. 2018 CFI J-12. 2019 CFI K-12. And 2020 CFI L-12. And I'll make these 2 decimal places to make it easier to see. But basically, those are the 5 years of free cash flow that we had forecasted, assuming that 2015 is a steady state for CAT. Now, on Monday, the next class, we'll basically change the assumptions, but for now, we're just kind of building out the model with some simple initial assumptions. Okay. Now, the next thing I need to do is I need to present value this, okay? Because these are not present valued. I'm doing my valuation today. So I need a present value of these free cash flows. So one typical way to do that is we create the concept of a discount factor. And a discount factor is 1 divided by 1 plus R to the N or T. So R happens to be the WACC. So discount factor is 1 divided by 1 plus the WACC. And the WACC is off the assumptions tab. That's the cost of capital. I'm about to copy and paste this. So I'm going to make this a $B, $4, so it always refers to that cell, B4 in the assumptions tab. Copy and paste this down. For the second year, 1 divided by 1 plus R squared, because it's 2 years. Third year to the third power. Fourth year to the fourth power. Fifth year to the fifth power. So those become the discount factors, and that gets me my discounted free cash flow, which equals the free cash flow times the discount rate, discount factor, and basically that's my discounted free cash flows. Now, if you wanted to skip a step, that's perfectly fine, and you wanted to directly discount the free cash flows like we had done in the previous model, you can do that as well. I'm just old school, because long time ago when I was a student like you, before the age of Excel, we'd have our calculators and sheets, and we would do the math and write things out. Okay, so I'm just kind of used to doing it that way. But if you want to directly discount cash flow divided by 1 plus R to the n, you're welcome to do that. So again, the key is I got to present value these cash flows. And then I want to sum them up so that my operating value in the first 5 years for, in this case, CAT, is the sum of that is a little over 16.8 billion. All right? So that is the value of CAT, assuming those free cash flows come true that we forecasted over the next 5 years. Okay? But companies last beyond 5 years, especially big publicly traded ones. So what is the terminal value or continuing value of CAT? Well, the continuing value or terminal value, as it's often known, is, and this is what's key, that continuing value is going to be the key value driver growing perpetuity equation. Okay, so we had previously talked about it. It's in the book. It's in the lecture notes. In fact, if we go back to the lecture notes, this is the formula. Okay, we've been using it a lot this semester. This is why we're using it, because it is the continuing value formula. And there's 4 parts to it. There's no plat, there's G, there's ROIC, and then there's the WACC. Okay, and so that's what we're going to put in. Except the way we're going to put it in is we're going to put it into the assumptions tab. Because as McKinsey talked about, one of the best practices to building a valuation model is you want to be really clear about where the changes occur. So we want to minimize how many places when we reuse the model that we put the changes. And that's why I chose yellow, because yellow highlights to me that this is something that I can change. You don't have to use yellow. If you want to use a different color, I don't really care. But you got to differentiate for yourself things that you shouldn't mess around with, because if you change certain cells, you'll break the model. So that's why I'm using yellow to say this is something I can change. It's okay to change. It won't break the model. If it's not yellow, be very careful. If you start changing things that aren't yellow, it will break the model. So what do I need to do key value drivers? I already have WACC. I need 3 more things. I need my continuing value no plat. I need my continuing value G. And I need my continuing value ROIC, which is also called RONIC, return on new invested capital, okay, or return on the incremental invested capital, okay. So in this case, it's the continuing value ROIC. These will be yellow because these will be the inputs that we will use. So where do I get my no plat? Well, that's my T plus 1. In this case, my 2021 no plat. That's what we did the 6th year. I find that in my TII. So no plat is row 4. 2021 is M. So M4 off of TII. Continuing value G, 3%. And we arbitrarily pick 3% and recognize it is arbitrary, right? Because we're assuming that the company is mature over the long run, and usually companies grow at about the level of the economy when they're mature. Hence, U.S. European companies somewhere around 3%, plus or minus. Right? Then we have our continuing value ROIC equals, and it's important we use the BOY ROIC. So if I go to the EP BOY tab, it's the 2021 ROIC after goodwill, so row 15, L15. That is the continuing value ROIC for the business. All right? So we now have the 4 components of the key value drivers. We just fill out the equation here on the DCF valuation tab, cell B9. So equals, and we want to basically put this formula into that cell with the correct order of operations. So left paren, and I'm going to do this all off the assumptions tab. So no plat times left paren 1 minus, from the assumptions tab, growth divided by ROIC, right paren, divided by left paren, WACC minus the CVG, right paren. So 66,464,000,000 and change. That is the value of CAT's free cash flow from year 6 into perpetuity. All right? And for those of you like, how did he get that? I'll put this back up on the screen. So that is the formula that you need with the order of operations to get the continuing value of the company off of the assumptions tab based on the rows that we had created. All right. Now, here's the thing. The continuing value formula, which is a growing perpetuity, basically implies a discount rate. So this is the discounted value as of the beginning of 2021. But I still need to present value it to today. Well, January 1st is the same as December 31st. So basically, since this is the beginning of 2021, it's the same as the end of 2020. So I want to use the same discount rate, same discount factor as the 2021, because I don't want 2020 discount factor, because I don't want to double discount 2021. I will get an error. It's a common error people make. All right. So basically, to present value that, take that times that. So the continuing value today is worth a little over 48 billion. And so therefore the operating value of CAT that we are forecasting is the sum of those two things, equals the 16 plus the 48 and change, or 64,881.94. So assuming our model comes true, that would be the operating value of CAT. Yes?
You said the formula was for continuing value discount for each one.
This one, it's just B times C. So I just have to take the 66.464 billion and I have to present value that to today. Okay? Because again, everything is in today's value when we do the intrinsic value of a company. Because the cash flow valuation is the intrinsic value of a company. That's what it's called. Yes?
We should have for continuing value.
Sure. So again, no plat times 1 minus G over ROIC, all that divided by WACC minus G. That was basically this formula off the key value drivers that were in the book that we've been using throughout the semester. Okay? All right. So, following Modigliani-Miller valuation, we take the operating value, we need to add in the non-operating value of a business. Right? So that's what we're going to do next. And again, this is where the TFI helps us. Okay? So on the TFI, we listed the non-operating assets and liabilities. They are here. So I want to put those onto my valuation tab. So equals from TFI, the 3 non-operating assets and liabilities, excess cash, non-operating assets less non-operating liabilities, and long-term investments and long-term receivables. Now, we are going to take the 2015 reported values, which is the last reported year, and they're already in a present value, so I just need the 2015 values, which is row G. So G9 for excess cash, G10 for non-operating assets, G11 for long-term investments. And again, I'll make it all 2 decimal places, just to make it nice and neat. And that, when I add up, becomes my enterprise value, which is the operating plus the non-operating values, 87,355.26. So again, assuming that our assumptions are correct, CAT would have an enterprise value of $87,355,000,000. It would be the operating value of the 64,881, and it'd be the non-operating value of 16,08,228, and 62,37. The cash, the non-operating assets, and the long-term investments. Now, here's the thing. Cash is cash. That's pretty simple. Non-operating assets, we don't always know what they are, but they're at least book value. The one quirky thing could be the long-term investments, right? Because accountants put long-term investments in other businesses at book value onto the balance sheet. And they don't put the market value on there, they put the book value. So if the market value dramatically differs than the book value, then we will not have an accurate valuation of the company. So here's an example. A long time ago, Microsoft put in $1 billion into Facebook well before Facebook went public, and they own 1/15 of Facebook, right? So Facebook is now wildly valuable. It's that 1/15 stake that was at the time a $15 billion valuation, pre-money valuation on Facebook is worth a whole lot more. But the accountants don't write up the value. They still list the book value of the investment. So we would underrepresent that value based on today's stock price. Right? Same thing. Even though Yahoo owns a big chunk of Alibaba, on Yahoo's books, they have the original amount invested. They don't have the market cap of the company today. So here's what we need to do. We're going to put an adjustment trigger into our model that if we do know that there's a wildly different valuation than the book value, we're going to go to our assumptions tab, and for reasons that will become apparent later, I'm going to skip a row, and I'm going to call this the price to book multiple of long-term investments. And right now I'm going to leave it at 1. And again, I'll make it yellow. But if I go to my valuation, I'm going to take my long-term investments and I'm going to multiply it by that price to book multiple. So here's the thing. If the investment trades at book value, it's worth $16 billion. If the investment trades at 7 times book value, then our model will quickly adjust it to be worth $112 billion. Okay? So obviously we need to have a data point to adjust it to not trading at book value, but regardless, we at least give ourselves an easy mechanism to adjust if we were valuing a company like a Yahoo to throw in the non-operating value of an Alibaba. Okay? So for most companies that you're going to do your group projects with, you're not going to, A, have much in the way of non-operating investments, and B, you're not going to have a lot of what they're worth because they're non-public entities. So we'll probably use book value as our proxy, but every now and then you might pick a company that can have a huge non-operating value, and this is the way that we'd have to start to deal with it. Yes?
Where would you find that multiple number?
Well, what you would have to do, a little bit of homework. Let me undo this for now. What you'd have to do, for example, is that if you go to Yahoo's balance sheet, you can actually see on the balance sheet the book value. And then B, what you do is you do a valuation of Yahoo. And then what you would do is you kind of do the operating value, take out the non-operating value, or even better in Alibaba's case, more simple. What you do is you look at the value of Alibaba, you look at Yahoo's percentage stake, and then you have the multiple of that percentage stake divided by the book value. So that's the easier way. But if not, you'd have to figure out the operating value and non-operating value of a company and kind of back into it. That's another way to do it. It's more complicated. But as I said, for most of your group projects, you're probably not going to mess with this. But I'm just leaving this as a mechanism if you were to run into a company like a Yahoo that you'd have an easier way of valuing them. Because you would have to separate out that big non-operating investment. All right. Questions about any of that? So that's a good question. Okay, so let's continue. So back to our DCF. This is the operating and non-operating values. Again, what we're really assuming is any future non-operating investments will be done NPV 0. Okay, so that's why we're really not forecasting the non-operating items. And the general idea is that you don't invest in companies for their non-operating items. Like you invest in Cat because you think Tonka toys are cool. You don't invest in Cat because they do other things, right? Because that's not what they're really about. So if they do other things, since they probably don't have good skill at them, at best they're probably NPV 0 propositions. So therefore, most people assume future NPV 0 incremental investments for non-operating. By the way, we do the same thing for acquisitions. So this came up in the last class. They said, well, how do you forecast acquisitions? And the answer is you don't. Because number one, by definition, you don't know what the company's going to acquire in the future, right? Unless you're an insider. And even if you're an insider, it's still not 100% certain. So it's really hard to forecast the value of acquisitions, especially when they're unknown. And number two, what the academic studies all show is the average acquisition is NPV negative by about 5%. The average acquisition destroys value. So when you go on to an acquisitive spree, the average says you're not going to create any value with the acquisitions, right? And the main reason is price. It's not that you don't get synergies. It's just companies pay more than often the synergies they get. And so therefore it becomes NPV 0. All right, so it's not saying that acquisitions don't benefit companies. It's just they often pay too much for that. So given that that's the standard of historical definitions, what we do for acquisitions is say, all right, even if you do an acquisition, given the price you're probably going to pay, it's probably going to be NPV 0. Right? And I'm just telling you, when you read through the headlines and you see a company doing an acquisition, you'll notice this. Because what they'll say is, oh, here's all the things that we can do with the company, and that's why we're paying a price premium. So that's the point. You put the price premium in there, you're paying for all those future benefits. You're not going to get a lot of upside to that acquisition because you paid for all that future benefit. So that's the challenge that companies actually have. And by the way, most people aren't going to sell because they're going to get sued if they don't price in the future benefits because that's already reflected of their stock price. So it's really hard to make money on acquisitions, right? Not saying that people don't do it. So back to this. Enterprise value. We then have to get to a common equity value because eventually we're trying to get to a share price. And here's where TFI once again helps us. Because on the TFI, we have to pay off everybody that's not a common shareholder before the common shareholders get paid. So who does that involve? Well, we've already identified them. It's the retirement-related liabilities. It's the interest-bearing debt, both short and long term. It's the preferred shareholders. And it's the minority interest of the minority shareholders. So those are the 4 people that generally we're going to have to pay off before the common shareholders get paid. And this is an example where if a company had somebody else that was different than those 4, that were non-standard, we'd have to pay them off too, right? So that's what I mean by eventually we might run into a company that has something that's non-standard. We'd have to figure out a way to add it to our model. But for most companies, these are the 4 most common that you'll run into. And that's why we're using these Bloomberg fields. So back to this. The value is the value today. So we look at the current amount outstanding. So in 2015, last reported year, which is G. So G14 is retirement-related liabilities. G15 is interest-bearing debt. Preferred stock is G17, which right now is CAT is 0, and minority interest is G18. And again, I'll make those 2 decimal places just so it's easier to be consistent. And that will get me to a common equity value. What I would do is I would take my enterprise value and I pay off those 4 things, and what's left is my equity value to the shareholders, to the common shareholders, because they get what's left after everybody else has been paid off. So then finally, I need my shares outstanding. Now, here's the thing. I don't want to, back to the best practice we talked about earlier, I don't want to put the shares outstanding here and hard-code it in, because if I do CAT, and like I said, if we do Ford or somebody else next week and the shares change, and I go here and I forget to change it, it's going to cause problems with my share price. So I'm going to put this on the Assumptions tab. And the assumption will be for the shares outstanding. Now, where I'm going to get the shares outstanding is I'm going to go to Bloomberg, and the easiest place to get them in Bloomberg, once you're at a company, is to type DES, which is the security description, and on this screen is the current amount of shares outstanding, 582.3 million. Okay, so 582.3. Just the easiest place to find it, because that's what we want. We want the current shares outstanding, right? And in the last class, I took a screenshot of this. By the way, this is an example of every month Bloomberg comes out with new software. So here's an example of something they changed in the March version of their software, where taking a screenshot is now completely different than it was in February. So some of you on the screens here in the classroom might actually see a slightly different way of taking a screenshot, which will change for you as soon as the software gets updated on those terminals. Because now it's called capture screen, I don't like the way the mouse works, and then you have to go to save. And I have trouble getting over to the second menu. And that's actually how you take a screenshot going forward. And this is what I mean by Bloomberg is constantly making improvements. You just have to kind of get used to some of the improvements that they make from time to time. All right. So in any event, I took a screenshot. I'll post the most recent one up there by Monday because we will use the current shares outstanding for CAT and the current price, 74.29, but 582.3. So back to my DCF valuation equals that. So my forecast share price, intrinsic value, another word, equals equity value divided by shares, $67.02. So basically, if our assumptions came true, we think CAT is worth $67.02, and that's just repeating 2015 going forward. And by the way, today, 74. Okay? So, and this is what the professionals would do, is they then, and this is the key, the science of valuation, the math, we just did it. It's just a bunch of algebra. There's a lot of algebra in a lot of fields, but it's not all that difficult math to do. The hard part of valuation is the assumptions themselves. Like, what's a good assumption, right? And that's where we'll go on Monday. Because in our next class, what we're going to do, and we're not done yet, by the way, but in the next class, what we're going to do is we're always going to do two valuations, right? The first valuation is called the as-is, which means we're going to look at the current stock price, and we're going to back into it to figure out what assumptions justify the current stock price. And it's not whether we agree with them, but what kind of growth rates, what kind of margins, what kind of returns must the market be using to justify the current stock price? Then, what is our assumption on growth and margin and return? And that creates what's called a target stock price. The delta is your buy, sell, hold. Okay? And by the way, what you might find is, I agree with the market. I think the company's fairly priced, and I don't have to do anything. That's called a hold. Right? But if my assumptions are different, then how do my assumptions change the value? And that creates the potential to buy or sell. So that's where we're going to go next with CAT and what you will do with your group projects as well. But regardless, we're setting up the ability to do that today. Questions about any of this so far? All right, so our final step for today is to create a final tab called the EP valuation, the economic profit valuation. Right? And the easiest way to do that is to take this DCF tab and clone it. Right? Because a lot of the work is already done. So right-click on the tab name in Excel, move or copy, create a copy, put it at the end, hit OK, and we'll have a copy of the DCF tab called DCF Valuation 2. Then rename it by clicking on it, EP for Economic Profit Valuation. Okay, so now I have two identical tabs in my model, just with one with a slightly different name. So I'm going to start on the EP valuation. As you read in the book, the difference between the economic profit valuation and the DCF methodologies is really how operating value is calculated. Everything else is the same, which is why we clone the tab. So let's focus on what's different about the operating value. Well, basically what's different is instead of looking at the forecast for free cash flow, we look at the forecast for economic profits, also known as EVAs. And that is a one-period change in value. I still present value those, so I'll still use the same discount factors, and that would get me the discounted economic profit as opposed to the discounted free cash flows. Right? And I'll still add them up. And that will get me, instead of the operating value, well, that will get me is the change in operating value for the first 5 years. So what's important to understand about economic profit is just a one-period change in value of a company. That's all it is. So where do we calculate that? That was off of the BOY EP tab. And the reason why we're using the BOY tab is if we use beginning of year economic profit, we should get an exact match between the two valuations. And I want to show that to you, so that's why we're going to use the BOY EP. So for 2016, so make sure you're using the BOY tab. 2016, economic profit after goodwill, so row 23, so G23. For 2017, off of the BOI tab, H23. 2018, off of the BOI tab, I23. 2019, J23. And 2020, off the BOI tab, K23. All right? Just make sure, because there's two tabs that are very similar, that you get it off of the BOI tab, not the EOI tab. So that gives me the change in value of the first 5 years. We're then going to add that to the continuing value, except there's a different formula for that, rearrange growing perpetuity. And then the final thing is we're going to add in our starting invested capital, which is going to be, off of the TFI, the 2015 last reported operating invested capital, so G7. So the idea is that the value, operating value, is these three things. It's how much value is created in the first 5 years, change in value in the first 5 years, how much value is created or destroyed in the continuing value period, change in value, the continuing value, and how much capital did we originally invest. So it's the invested capital plus the change in value equals the operating value of the firm. So we'll just add those three things up, and that's the operating value. But the difference is the formula for continuing value of economic profit is slightly different than the formula for continuing value of free cash flow. Okay? So from your readings in the book, and I put it onto this lecture note, it's that formula. Yes?
You said the starting invested capital is 2016?
The 2015. Should be 2015. So it's whatever December 31st, 2015, or whatever the final reported number is for the company. That's the one we're going to use. Other questions? All right, so this is the hardest part of the assignment. Getting that formula with the correct order of operations into our model. First thing, with the key value drivers, there were 4 components. There's a 5th one that's added here, which is the continuing value economic profit. It's the economic profit in T+1, which is the 2021 economic profit. So if you go back to our Excel Assumptions tab, you'll see that I skipped a row for a reason. This is the reason. Continuing value economic profit. And that is coming from equals the BOI economic profit for 2021. So L23. Again, make sure you use BOI, not EOI. Okay, I'll make that 2 decimal places. So it'll be these 5 things that we will use to create this big formula in this cell. Okay, so see if we get this right. Equals left paren economic profit divided by WACC. So I'll do this all off the Assumptions tab. So CVEP divided by WACC, right paren, plus left paren, no plat, so CV no plat, times left paren, G over ROIC, so CVG divided by CV ROIC, right paren, times left paren, RONIC minus WACC, so CV ROIC minus WACC, right paren, divided by left paren, WACC, times left paren, WACC, minus CVG, right paren. All right? Assuming I did it correctly with the correct order of operations, I hit enter. Don't get an error. And here's how I will know that I got the correct number. This is the change in value from year 2021 forward. This is the present value of the change in value. This is the sum of those three things above, which is the operating value of CAT. This is the economic profit approach. This is the DCF approach. Those two numbers should be identical. So I'm going to put in a little check just to make sure. So what I'm going to do is I'm going to take the operating value of the DCF. I'm going to subtract the operating value that we calculated from the economic profit, and the difference should be 0. The difference shouldn't be $1, shouldn't be 0.1, it should be exact. And that's what I wanted you to understand, right? Is that basically what we're really talking about with these different valuation approaches is just rearranged equations. That's all it is. It's just rearranging the equation. That's what McKinsey tried to convey to you in the textbook, is that the value of a company doesn't change. The approach changes, but you still have to get to the same answer because all of these different approaches are just rearranging the math. So you might say, well, why do we rearrange the math? And we do it for insight, right? That's what's most important about this process. So for example, what I know in the DCF valuation, assuming my assumptions come true, by the way, is that CAT is worth almost $65 billion. But what I know in the economic profit valuation is most of this value is created in year 6 going forward, not the first 5 years. And a good chunk of the value is the fact that CAT put $42 billion, $42.6 billion of capital into the business. So Stern Stewart actually has something called market value added, with a look at the difference between the operating value and the actual capital invested to see how much value you've actually created. Because one way to create value is just to build a bigger company. Just throw more assets in the business. That makes you more valuable because you're bigger. Doesn't mean you're better, right? So what we can see in the economic profit method is how much value is really being added to what you're spending. And that's why it's an interesting approach, right? But that's essentially what we're doing in the second tab. Now, if you use EOY or if you use average invested capital, you get close. You get really, really close, but you don't get exact, right? And that's why we're using BOY. Just for purposes of academically, I wanted to show you the equivalence of these two models. Now, in the real world, people don't use BOY as much. They use EOY or average, right? But regardless, when we build the model, we built it for this reason. All right, so questions about any of this? Hopefully pretty straightforward. All right, well, here's what I consider the good news. If you were able to get to this point, and by the way, this point includes getting this formula correctly. There it is, in case you need it one more time. Then that's the other part of homework 7, you're done. So basically, homework 7 involves two things. Get to this point, match it exactly, upload your Excel file, not somebody else's, you're individually doing this, and go to Bloomberg, create the export that matches that model data tab, export that to Excel for 6 years, and upload that as a second file. That's homework 7. Okay, so we've pretty much completed this part of it in class today.
We're doing it for CAT.
We're doing it for CAT. Okay, so here's why we're doing it for CAT, and here's a preview of Monday. So coincidentally, in the fall 2015 semester, last semester, the day we were doing this model in class is the day that Nicole DeBlas, who is the sell-side analyst that covers CAT for Morgan Stanley, came and guest lectured. And she brought in her actual model for CAT that Morgan Stanley uses. And that is this file. And she said we can distribute it within this class So, because it's essentially public data, but this is the file, which I'll show you a little bit more about on Monday. So I'll disable the macros here. But this is what she does. That's her team. And she's the number 5 ranked sell-side analyst for the manufacturing industrial business. So she's pretty good at what she does. And so here's what's interesting about the actual model Morgan Stanley uses, is if you look at the tab, they have a tab called DCF. And if you click on the DCF tab, now it's prettier than our model, right? But it's basically what we do. So if you actually drill down, what you'll see, I'll make it a little bit bigger here, is she's got a margin, she's got investment in capital, she's discounting it all, she's got historical data and future data, and she's got a continuing value, which they call terminal value. And by the way, they do this little grid where they have different continuing value growth rates, and they have different WACs, so they can do a different sensitivity where we're just kind of doing one. But basically, they then create, again, there's the WAC, there's a long-term growth rate, and then there's the valuation of CAT.
These are share prices.
These are share prices, given that sensitivity. And here's the other thing. We're going to be doing this, not next week, but after that, the week after that, we're going to get into multiples. And what I want you to understand is multiples are just an expression of intrinsic value. So you'll see in her model, they have another tab called multiples. We're going to add a tab called multiples in ours just as well. And so basically this is her calculation of assumptions that lead to different multiples. And it's actually synced or triangulated with the DCF. And that's the point. What people don't really seem to realize is that multiples aren't some foreign thing that has nothing to do with the cash flows. They're actually based on the cash flows. That's why you had the midterm problem that I gave you, is that multiples are an expression of growth, return, and risk, and cost of capital. And so that's the point. Like if you're going to trade at 10 times EBITDA, it's not because the market's trading at 10 times EBITDA, it's because there's an expected growth rate, an expected return, and a cost of capital associated with that multiple. So what happens is on the conference calls, an analyst like Morgan Stanley will talk to you in terms of multiples. Like you should trade at a multiple of PE of this and an enterprise value to EBITDA of that. But what's behind that is the cash flow DCF that supports that multiple, which is the growth rate, the margins, the returns. And that's what you're going to start to see is synced and calibrated. So long story short, when you do your group projects, those are the final 2 sections of the group project that we hadn't covered in the first half of the semester, is that as of Monday, you're going to pick which public company you're going to value. And over the next 3 weeks, what you're going to do is you're going to do the valuations, the as-is and the final, and you're going to do the DCF, intrinsic value, you're going to do the EP valuation, and you're going to do the multiples valuation. And you're going to sync it all up, and then you're going to give me your recommendation for the final share price. So that's what you're eventually going to write up and present. But this is the basis for how it all starts to fit together. Does this make sense? So conceptually, that's where we're going. Academically, we pretty much covered 98% of the content from the book that we're going to need. Everything else for this is just now making it practical in the real world and then figuring it out. Because what I said earlier is actually true. The hardest part of valuation is not the math. The math is easy. The hardest part of the valuation is how do you actually make the assumptions? Like what's a realistic growth rate? What's a realistic margin? What is the right cost of capital to use? That's the hard part. That's what we're going to be digging into over the next few weeks. And some of it is going to involve doing external research and figuring out for these companies. By the way, that's why you're doing the EIC. Not just having you do the EIC for the hell of it. I'm having you do the EIC because eventually you're going to have to create assumptions, and you need something to base the growth assumption on. Right? And it shouldn't just be math. Like those are the worst assumptions, where you just look mathematically at the past and you predict the future. Because unfortunately the past is not a direct predictor of the future. And so we have to come up with these future assumptions. So that's where we're kind of going with this. And to me, this is the more interesting part of the semester. Because now we can really dig into opinion about the future. And by the way, nobody's right. Right? Because there is no right answer because it is the future. Nobody can directly predict the future. If you could, you wouldn't be in this class. You'd be someplace else. and so that's the other part of it is how do we get into the art of valuation. So back to Monday. I see many of you are already taking advantage of the time in class. Please do. Complete out your Bloomberg tab for the model. So you have the model data. And the other thing is complete what we just did in class. Submit both of those by Monday, and then we'll pick up from there. And on Monday, we'll do the as-is and final target valuation of CAT based on current data. Okay? Otherwise, have a great weekend. See everybody on Monday.
Is there a class meeting or no?
Stop.